you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and today we're gonna talk about the American debt crisis, and we're gonna see where we're at with consumer defaults and delinquencies. Now, I believe that as we move into further on in this year and into 2024, that the health of the consumer will continue to deteriorate enough to start creating enormous financial uncertainty and harm in our economy. Essentially, I believe that the delinquencies for consumers is what is going to lead us into recession. But the question is, where are we at right now when it comes to the auto loans, credit card, home loans, bankruptcies, school loans, excess savings, the savings rate? We're going to look at all of those things today, but I'm going to be clear. I believe, again, you guys, the entire economy is like a house of cards fixing to fall. In fact, we recently had our number 5 bank failure at Citizens Bank fall apart because of bad auto loans. So the more and more consumers start to not be able to afford their bills, the more and more we're going to see the uncertainty happen across the nation. And that uncertainty is going to hit the banking sector. And when that happens, guys, when more and more banks start to go under, all that's going to do is cause more and more credit tightening. So it's especially important that if you want to be a winner, you want to buy a house, or you want to buy assets for undervalue, we need to be preparing right now. What we don't want to do is be blindsided. We don't want to wait until it's knocking on our door and like, oh, by the way, the recession's here and unemployment's unhinged. We want to be proactive right now by empowering ourselves and fixing our credit, our income, and our assets. Can you guys just shoot me a bonkers below? That makes me feel so good to hear you guys say bonkers in the comment section. So just shoot me a bonkers real quick. But where I'm going to start, you guys, is the inequality in earnings. We have a way more difficult time as consumers today versus consumers in the 1970s as far as the ability, just the ability to save money and to even pay bills. So not only is life more expensive, we're also making a lot less money and have a much harder time just affording to live. Let me show you. This is pretty crazy stuff, guys, but inequality in annual earnings worsens in 2021. This was issued in December of 2022. The top 1% of earners get a larger share of the earnings pie, while the bottom 90% lose ground. So in other words, guys, the rich get richer and the poor get poorer. Let me read a few snippets here. From 1979 to 2021, wages for the top 1% and top 1% skyrocketed by 206%, and for the upper class, 465%. That is insane, while wages for the bottom 90% grew just 28.7%. So the rich people made 465% more, while we made 28.7% more. Do y'all start to see the problem just right off the bat? We should see there's an issue right off the bat, which is why I always think we should be self-employed. Even if we're full-time, get another job, work for yourself, see how great that can be. It's also very scary. Now, on an annualized basis, the bottom 90% wages grew only 0.6 per year, compared with a 2.7 and 4.2 annualized wage growth for the top percentage. We get 0.6 and the top people get 4.2. That's pretty shocking, isn't it? We can really see the divergence right here. And that really started in the 1980s. And that's why I constantly tell people the consumers today, and we can see it in this chart, we're nowhere near like the 1980s. At least back in the 70s and 80s, we got our fair portion of the wages. So if a corporation started doing better, they would reward their employees. That doesn't happen today. They will fire you and replace you with someone else. But look at the gap. As time went on, the gap just really got out of control. And it's very interesting to note, it really started spiking in the 2000s, and the recession hit. It really started getting out of control again in the last great financial crisis. A recession hit, it went down. And look, it spiked up again. So what's going to happen next, guys? Do you guys think a recession is going to hit and it's going to bring this gap closer together? I certainly believe it is. We have historical precedent saying it will. Consumers today are facing an uphill battle to be back to an affordable lifestyle, an affordable way to live. I mean, I miss it. It's hard for me to remember when things were just, I don't want to say easy, but it wasn't as bad as it is today. And it's very hard to stay focused on hope. So preferably you guys are holding on to hope. And I'm not talking about false hope. I'm talking about you work hard, you empower yourself, and you should get ahead in life. That type of hope, not false hope. Now let's take a look at credit cards. The millennials right now are doing horribly. It's really not even comparable when we compare anything else, but millennials, you guys, are drowning right now. US credit card debt stayed above $1 trillion. We have over $1 trillion of credit card debt. And look at the trajectory ever since about, what would you say, about Q3 of 2021? I mean, people started spending like crazy because they were being paid back by the government. But the problem is, guys, that stopped, but the spending continued. In fact, the COVID stimulus stopped, but credit card spending habits got even worse. The share of newly delinquent borrowers grows. The youngest Americans are finding it harder to dig themselves out of credit card debt. Credit card debt is absolutely horrible. During the third quarter, some 2% of credit card users moved from current status in the second quarter to a 30-day or more past due on at least one account in the third quarter. According to the New York Fed, that's up from 1.6% in the first and second quarters of 2023, and higher than the third quarter average of 1.7 between 2015 and 2019. So delinquencies are high and skyrocketing, but it's not where we were at during the great financial crisis, except with subprime debt. Subprime debt right now is worse right now than it was during the great financial crisis. But overall, we're headed that way. We're not there yet. Let me keep reading. Those flowing into serious delinquencies on credit card, which are 90 days or more past due on payments, posted the largest increases out of every debt category. Overall, the flow of debt moving into delinquency hit 1.28% in the third quarter, and that is up from 0.94% a year ago. Now, what's really especially surprising about all this, guys, is not only can credit card debt literally last you 40, 50 years. If all you're doing is paying the minimum payment, you're going to be trapped in credit card debt forever. On top of that, the APRs and interest rates on credit cards right now are historically high right now. So a lender can give 3 credit cards out as long as one of the 3 persons are making minimum payments. It's profitable. The other 2 could go into default. That's how profitable credit card debt is, and that's how much it shackles people. It traps people. It's a financial prison. It is so hard to get out of credit card debt, y'all, once it spirals out of control. Most people have to go into bankruptcy. And to put this in perspective, here's the credit card APRs. Again, this is a 38-year high. We're sitting at right now, you guys, 20.72. Okay, so 20.72. Going into the great financial collapse, we were only at 13.97%. There are some things going on right now that are worse than the great financial collapse. Now, even though that defaults may not be at that level, remember, you guys, we're doing quantitative tightening in the front end of a recession and unhinged unemployment. This stuff doesn't get like too bad until we enter recession. So the real bad stuff, it hasn't even happened yet. Hasn't even happened yet. I'm simply showing you guys that it's a house of cards, and a gust of wind can knock this whole thing down. Now, the balance of auto loans and leases rose by 0.8% in Q3 from Q2 and by 4.7% year over year. We have right now $1.6 trillion in vehicle loans. Again, you guys remember, Citizens Bank just went under because of basically defaults in trucking loans. So $1.6 trillion at stake here. And again, depending on the bank, if the bank has a huge portfolio of a non-performing asset, especially in subprimes, they're going to go under. I'm telling you guys, the defaults and delinquencies are going to be putting banks out of business, especially if they gave out subprime vehicle loans. Look at before like 2013, it was a lot more balanced, but right now it's just like, geez, the spending habits of Americans right now is just really out of control. At least looking at the numbers, it appears that it's just too much. It's just too much. People are fixing to learn a very valuable lesson through this recession. Let me show you how bad things are right now again in subprime. There's a catastrophe happening right now in the vehicle department when it pertains to subprime vehicles. And subprime means giving a loan to someone in less than optimal credit, right? So they got challenges. Subprime is always more or less in trouble. That's why it's subprime. In the auto market, selling and lending to customers with subprime credit rating is high risk, high profit, specialized activity. largely limited to older vehicles. Okay, so a lot of people want to do this because they get to charge such high interest. But let me show you guys the delinquency rate. So again, you have all of these lenders that are greedy, like, yeah, let's give to the subprime because we make more money. But look at the delinquency rate, you guys. The auto loans for 60+ day delinquencies, look at this. This is unprecedented. We have never had as many delinquencies, never had as many delinquencies as we have right now with subprime vehicles. In fact, look at the delinquencies right here during the Great Financial Crisis. During the Great Financial Crisis, we peaked at 5%. During the recession, okay? Right now, we're over 6% in the front end of recession. So please, guys, comment below, okay? This is a serious question. Do you think auto delinquencies are going to get worse or better during recession? Comment below. Do you think it's going to get worse? Type in worse or type in better. Personally, I think it's going to be worse, but look at the trajectory. It's just going straight up, you guys. This is a huge problem. So throw subprime auto vehicles right in there with commercial real estate meltdown. There is a subprime vehicle meltdown happening right now, and we can see it clear as day in this chart. Unlike most debt, you cannot go bankrupt on federal school loans. And we'll go over bankruptcy stats here in a minute, but you cannot go bankrupt on your school loans. In fact, look at this article, you guys. Think twice before participating in student loan strikes. So this article actually goes into how some large part of the country right now is trying to go on strike and not pay their school loans. That may be fine to do right now with the administration passing, the rules that they did. But I'm going to tell you guys, by doing that, all that's going to do is add to more fees and more penalties being tacked onto your school loans. You have to pay your school loans. The fact that people don't think that they have to, it's mind-blowing to me. I mean, COVID really messed up the minds of Americans. There's a lot of people right now trying to do a strike. Now, there is an initiative put into place. It's a 12-month student loan on-ramp period that started this month. So they basically got 12 months to not do anything, and it's going to have limited impact on their credit. But again, remember, interest charges still build, and there's no progress towards loan forgiveness and really no progress towards paying your loan down. So, why are they rioting for something that they know they have to pay? And you want to know what the crazy thing is? This isn't even like credit cards. They should be mad about credit cards, not school loans. School loans work with you to make payments. Some of those school loans can have an interest rate 2, 3, 4% and go off of how much money you're making. Credit card debt, on the other hand, are making corporations filthy rich, literally filthy rich, and they're protesting school loans. I just don't think people's priorities are in the right place right now. Let me show you guys what's going on now with the bankruptcies. Again, you guys, bankruptcies are absolutely skyrocketing. The trajectory of everything is alarming. Not everything is at great financial crisis levels, but the trajectory is headed that way. And what's especially, again, really astonishing about all this is before unhinged unemployment. Unemployment's only 3.8, and we're having these types of problems at a 3.8% unemployment. Think about what I'm saying, y'all. Let's look at bankruptcies. This is a shocking headline right here, you guys. Nearly 1 in 5 high debt consumers with credit score issues have filed for bankruptcies. 20% of consumers that are struggling with debt and with credit, 20% filed bankruptcy. How the heck is that possible before we even are in the recession? Let's read some of the stats. And this one right here, you guys, is very alarming. In some cases, consumers reported having to file bankruptcy due to a lack of funds to cover overdraft fees. Did you hear me, guys? That's how much people on the bottom are suffering. Some people are filing bankruptcy because they can't afford their bank account fees. So here's some stats on the people that had to file bankruptcy. And really what I want to point out are the stats on the right side, because what this is telling me is that if these people could continue to get into debt and could continue to spend, they would. The only reason they're not is they don't have the ability to. So when you take the ability for someone to stop doing something, it usually stops, but unfortunately, they're not doing it on their own. And if you look here at the people that had to file bankruptcy, 17% had high debt, 7.1 had no debt. Now, the ability to access high interest rate loans, look at you guys, 19%, 17%, and 12%. And look at the inability to get credit cards, 23 and 32%. Inability to get more credit, 28%, 31%, and 23%. To me, what this data is saying is, yes, I understand inflation's bad. It is a lot harder to afford to live. But we can't disregard that America has a massive spending problem. Payments reported this increase represented a total of 418,000 annual bankruptcy filings during this period. Of these filings, non-business bankruptcy cases rose by 9.5% to 403,000. The spike in bankruptcy filings is noteworthy considering that filings have only rarely increased over any 12-month period since 2010. Are you guys hearing what I'm saying? This is insane, right? As the country grapples with record high consumer credit card debt, it is crucial to address these issues and provide support and resources to consumers facing financial hardships. Implementing financial education programs can empower consumers with the knowledge and tools to maintain their debt effectively. In other words, take my home buying course, please. It's for free. It's only going to help you. Let me read this last conclusion. In conclusion, the combination of high debt, credit score issues, and reliance on overdrafts has created a challenging financial landscape for many consumers, and the burden of overdraft fees, damaged credit, and limited credit accessibility has pushed some individuals to file for bankruptcy. The way that we're set up as a country is ran off of consumers getting into debt. So I get it, but again, it's never been more important though for us as consumers to check ourselves before we wreck ourselves, right? Just slow down, stay disciplined, be empowered by your self-sacrificing, be hopeful that the harder you work, the further you get ahead in life. Don't give up and join the rat race. Now, here's where we're sitting at as far as mortgages. The mortgage delinquency rate is extremely low, although forbearance plan delinquencies are a record high. So people that are already in forbearance plans, that's unraveling, but actual foreclosures, it's very, very low, except, okay, with FHA loans. FHA loans, for some reason, are substantially higher than conventional. And if you look here, FHA loans are the only product where delinquency rates are above their pandemic entry point by 109 basis points. So FHA delinquencies are really, really bad right now. Difference of ownership from 2022 and before to 2022 and on is completely different. They're not anywhere close to being the same. Now let me show you guys the inability for consumers to even save money. Unlike the last recessions that we've gone through during the entire time of the existence of the United States, consumers cannot save money right now. They can only spend money and get into debt. Let me show you. Starting with the personal savings rate, I mean, it's in the dump, you guys. We're only at 3.4%. That's it, 3.4%. Consumers can't save their money. Back in the 1970s recession, it was 12.4. Every recession in the 70s and 80s, it was double-digit savings rate. Going into the recession, right now it is 3.4%. So in my opinion, you can't say the consumer is strong. If people are saying the consumer is strong, what they're saying is they have more debt they can charge. That's what they're saying. They have more debt that they can charge. To me, a healthy consumer is one that is saving money and has the ability to do so. The last thing here, guys, is the fact that the excess savings from the COVID money printing is almost gone. You can see that in this graph here. I mean, we had a ton of money, about $2.1 trillion in excess savings that was basically wired into our bank accounts. But again, you guys, that is deteriorating extremely, extremely quickly. More than likely, it's going to be completely gone by the end of this year or the start of 2024. In conclusion, we have a lot brewing in the consumer debt and delinquency department. I mean, literally everything except conventional mortgages, as far as delinquencies, are skyrocketing. Everything except for conventional mortgages, unless we look at the forbearances. If we look at the forbearances, the same thing is happening. Delinquencies are skyrocketing. But where I want to end, guys, is I really want to warn you about consumer debt. Remember, the more consumer debt that you have, the less purchasing power you have as well, by a lot. Even if you only have $1,000 in monthly payments, that could kill $100,000 to $200,000 in your purchasing power. So again, avoid debt at all cost. And as we go into the recession, more than likely, it's going to be harder and harder to even qualify for a loan. Now, other than that, guys, I hope this gave you guys a bigger picture on the health of the consumer. We're not at great financial crisis levels yet, but we are headed that way. Now, if you're out there investing in real estate, you know I wish you luck, and I hope you win.